The AI infrastructure race is coiling tighter, and Nebius Group might be sitting right at the spring's breaking point. As demand for hyperscale systems collides with real-world grid limits, we're dissecting the Q4 FY25 numbers to uncover the truth. Is Nebius building the future or borrowing from it? To understand Nebius, you have to decode the infrastructure bottleneck. We're seeing a major performance divergence, a slight Q4 revenue miss contrasted against a massive beat in annualized run rate or ARR. While the AI cloud engine is in hypergrowth, heavy capital expenditures and market sentiment are compressing valuation multiples in the short term. The verdict is simple. Unstoppable demand has met physical reality. Total revenue plummeted forward at 547% year-over-year, and the annualized run rate smashed guidance to hit $1.25 billion. However, with over $2 billion in CapEx and zero buybacks, Nebius is currently gated by power availability in megawatts, not a lack of customers. Let's look at the numbers behind that miss. Q4 revenue came in at $227.7 million, about 8% below the $247.5 million consensus. The cause wasn't a lack of orders, but specifically power connectivity timing. Meanwhile, the $1.25 billion ARR significantly outpaced the $1.1 billion guide, proving the pipeline is massive. The AI cloud is the undeniable core of this business, representing 94% of total revenue. Revenue in this segment is up a staggering 830% year-over-year. Operations are expanding from the primary EMEA nodes in Finland and France into a rapid new capacity expansion in New Jersey to capture the North American market. We're witnessing the first ever transition to positive operating leverage. The core AI cloud unit achieved a 24% adjusted EBITDA margin this quarter, crossing the break-even threshold with $15 million in positive EBITDA. Gross margins have surged by about 1,000 basis points to roughly 70% as GPU utilization hits peak levels. Nebius is also cleaning up its balance sheet by shifting away from paper compensation. While revenue grew 547%, stock-based compensation, or SBC, dropped from 24% to just 5% of OPEX. This proves the underlying business is generating fundamental value rather than just printing new shares to pay employees. This is the reality of land-grab infrastructure economics. Even though cash from operations is positive at $834.3 million, driven largely by customer prepayments, it is completely swallowed by over $2 billion in capital expenditures. This aggressive spending is necessary for H200 and Blackwell GPU acquisitions, resulting in a negative free cash flow of $1.22 billion. To survive this phase, Nebius has built a liquidity wall of $4.1 billion in cash. However, keep an eye on the days sales outstanding, which spiked to 286 days. This is due to a $720 million spike in accounts receivable tied directly to the billing cycles of massive contracts with Meta and Microsoft. The valuation tells two different stories. On a trailing basis, Nebius looks expensive at 46.8 times price to sales. But if you look at the forward 2026 projections, based on a $3.2 billion midpoint, the multiple steps off a cliff to just 7.5 times. This premium is justified by their proprietary data center design compared to simple hardware resellers. The bull case rests on the arrival of Blackwell GPUs in early 2026, which command 50% higher average selling prices, and the multi-billion-dollar revenue floors provided by Microsoft and Meta. The bear case is the physical grid. If utilities fail to deliver the 800 megawatts to 1 gigawatt by year-end 2026, growth hits a hard ceiling. The core thesis is that Nebius is an infrastructure coiled spring. Unprecedented demand from the world's largest tech companies is being squeezed through the bottleneck of physical power grid limits. This backlog creates a delayed surge, supporting their reaffirmed target of $7 to $9 billion in ARR by the end of 2026. Remember these three things. First, demand is vastly outstripping supply. Second, we've reached a margin inflection point where the model is proven to work. Third, trailing multiples are a mirage. The forward value depends entirely on successfully plugging into the grid. What's your verdict? Is Nebius Group the ultimate underlying infrastructure play for the AI boom? Or is it a massive debt-fueled trap waiting for GPU rental prices to crash? The numbers show hypergrowth, but the grid holds the key. Drop your thesis in the comments below. If you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.